Welcome to the Daily Market Recap. Today is Monday, June 29th, 2026. What a massive sigh of relief on Wall Street after enduring a brutal five-day losing streak. The bulls finally charged back into the arena today. The flagship SPY climbed a gorgeous 1.2%, while the tech-heavy QQQ absolutely dominated the floor with a roaring 2.1% explosion. Even the blue-chip Dow joined the party, jumping 366 points or 0.7%. Why the sudden shift from absolute panic to pure euphoria?
We can thank a beautiful combination of cooling geopolitical tensions over the weekend and a fierce dip buying wave hitting the tech sector. Investors who were hiding out in defensive cash over the weekend sprinted right back into risk assets the second the opening bell rang, completely erasing last week's tech hangover.
Taking a look at the heat map, it was a beautiful sea of green across the high beta growth sectors. Technology and semiconductors absolutely crushed it today, acting as the primary engine of this massive relief rally. Communication services also had a blockbuster session fueled by some huge corporate shakeups that we will break down in just a minute. On the flip side, defensive sectors like consumer staples, utilities, and real estate saw some minor capital rotation out of them as traders abandoned their safe havens to chase growth. Energy stocks also had an incredibly choppy session, despite Brent crude climbing 1.8% to nearly $74 a barrel due to lingering Middle East supply anxieties. The broader market's appetite was strictly focused on high-flying tech. Now, despite today's explosive green candles, the broader market sentiment is still deeply scarred. The stock market fear and greed index is currently sitting at a chilly 27, firmly locked in fear territory. This tells us that today's massive bounce was a classic coiled spring relief rally. When retail and institutional investors get this terrified, the market becomes heavily oversold, meaning even a tiny bit of good news can spark a violent short squeeze. We are not fully out of the woods yet, and the crowd remains highly skeptical, but a reading of 27 is historically right, where savvy, long-term buyers love to step in and start shopping for deep discounts. Our top story today is a jaw-dropping corporate divorce that sent massive shockwaves through the media landscape. Telecom giant Comcast announced a sweeping plan to completely split off its NBC Universal media business and Sky from its core broadband and wireless business. The market absolutely loved this strategic financial engineering, sending Comcast stock flying over 6.7% higher on the day. For a stock that entered today down over 17% for the year, this is an absolute game changer. By separating the legacy cable and high-growth broadband side from the volatile streaming entertainment side, Comcast is unlocking massive shareholder value and giving investors a clean choice on which business model they actually want to back. In a historic index shakeup, Google's parent company, Alphabet, officially made its grand debut inside the prestigious Dow Jones Industrial Average today. This is a massive milestone that highlights the unstoppable structural tilt toward big tech in the broader economy. Traders were eagerly piling into the stock ahead of the inclusion, providing a beautiful structural tailwind for the entire megacap complex. This historic inclusion essentially means that the Dow is no longer just your grandfather's old-school industrial index. It is officially becoming an AI and tech-driven powerhouse. Rounding out our top news, global chip juggernaut Samsung Electronics and SK Hynix just dropped an absolute nuclear bomb of a headline, announcing a mind-blowing $518 billion investment to construct a massive, state-of-the-art chip-making hub in South Korea. The goal to fully capitalize on the insatiable, surging global demand for AI-enabling hardware. This colossal commitment injected a massive dose of pure adrenaline straight into semiconductor equipment suppliers. Applied Materials rallied a staggering 11.5% on the news, bringing its spectacular year-to-date gains to an unreal 172%. If anyone was worried that the artificial intelligence infrastructure boom was slowing down, this $500 billion bet just completely silenced the bears. Let's dive right into the wild world of individual stock movers. While the broader indices were enjoying a highly coordinated relief rally, several individual tickers were experiencing absolute double-digit madness. We saw massive short squeezes, retail frenzies, and some devastating corporate sell-offs that left a few portfolios completely in tatters. Let's break down the four biggest rock stars and the four biggest disasters of the session. Leading the charge for the bulls today, we saw a phenomenal performance from OUST, IRDM, FCUL, RBLX. LiDAR technology favorite OUST exploded higher as institutional buyers scrambled to accumulate shares following a fresh analyst upgrade, highlighting its dominant position in autonomous vehicle supply chains. Satellite networking giant IRDM soared after securing a massive government infrastructure contract expansion. Meanwhile, alternative energy play FCL caught a violent short squeeze as retail traders flooded the options chain, and gaming giant RBLX surged beautifully on rumors of soaring active daily user metrics ahead of its upcoming earnings report. If you held these today, you're smiling all the way to the bank. Now for the ugly side of Wall Street, the absolute train wrecks of the day belong to BLD, Snex, HWKN, Gap. Building materials distributor BLD suffered a nasty markdown after a prominent Wall Street firm issued a sweeping downgrade citing cooling commercial construction data. Financial services play Snex got hammered following an unexpected earnings miss that revealed tightening operational margins. Chemical supplier HWKN plunged as supply chain bottlenecks raised concerns about upcoming quarterly guidance, and retail apparel icon Gap fell out of style fast, giving back last week's gains as consumer discretionary spending data continues to flash warning signs. Ouch. Turning our eyes to the technical charts for the S&P 500, tracking via the SPY ETF. Today's 1.2% bounce successfully defended a critical technical line in the sand. Bulls stepped up beautifully right at the key support level of 538, preventing a much deeper technical breakdown. Looking up, the immediate overhead resistance sits firmly at the 550 psychological level. If the bulls can build on today's momentum and slice through 550 on strong volume, it clears a direct path back toward the all-time highs. However, if we fail to hold this bounce, watch out for 532 as the next major line of defense. The tech-heavy QQQ chart looks like an absolute beast after today's 2.1% explosion. The index swept right through minor overhead resistance at 475 like a hot knife through butter. Right now, the immediate upside resistance target is sitting at 488, which represents the previous local top. Support has now officially solidified at the 462 level, which held beautifully during last week's tech rout. As long as the QQQ stays above 462, the structural uptrend remains completely intact, and today's price action proves that institutional dip buyers are still incredibly aggressive. Interestingly, small caps completely missed the memo on today's party. The Russell 2000 ETF ticker IWM was completely flat, scraping out a tiny gain of less than 0.1% to close at 3,1042. Technically, IWM is trapped in a very tight consolidation box. Crucial support rests at the 2,980 level, which bulls must defend at all costs to avoid an ugly trend reversal. On the upside, resistance is heavily stacked at 3,050. Small caps are clearly losing the liquidity battle right now as capital rotates aggressively back into mega-cap tech giants. Moving over to the digital asset space, Bitcoin is locked in an epic high-stakes tug-of-war right around the critical $60,000 psychological milestone. We are down roughly 52% from the spectacular all-time highs near $126,000 reached late last year. The crypto community is completely split right down the middle. Half believe this is a rock-solid cyclical bottom fueled by extreme fear and heavy institutional ETF inflows, while the other half fears a deeper late-cycle correction down to $55,000. Key levels are crystal clear. Immediate macro support rests at $58,100, while the bears are fiercely defending resistance at the 50-month moving average near $65,600. Ethereum is exhibiting a very similar holding pattern, trading nearly unchanged right around the $1,574 mark. Despite the flat price action, there is some massive institutional accumulation happening behind the scenes. Digital asset titan Bitmine announced it has aggressively lifted its Ethereum treasury to an astonishing 5.7 million ETH, navigating right through a very challenging weekly slide. To add even more legacy validity, Bitmine officially joined the Russell 1000 index today. Technically, ETH needs to reclaim the $1,650 level to spark a true bullish reversal, while a breakdown below $500 could open the trapdoors for a retest of the yearly lows. The broader altcoin market is showing massive fragmentation, flashing mixed signals across the board. It is no longer a market where everything moves together. While major Layer 1 assets like Solana and Avalanche managed to carve out decent daily gains thanks to localized developer activity and network upgrades, other mid-cap utility tokens experience steady distribution. This hyper-segmented performance tells us that crypto traders are becoming incredibly selective with their capital, favoring established networks with real protocol revenue over speculative hype assets. As we look ahead to tomorrow, the market sentiment can best be described as cautious optimism. Today's tech-driven relief rally was fantastic, but to prove it is a sustainable trend and not just a dead cat bounce, we need to see solid follow-through volume tomorrow. Keep a super close eye on the early morning macro data drops, especially the upcoming manufacturing index and consumer sentiment reports. If the economic data comes in too hot, it could easily revive inflation fears and spike bond yields, putting immediate pressure right back on our beloved tech stocks. Stay disciplined, manage your risk, and let's see if the bulls can keep the flame alive.